Welcome back to EDS, and in this video I'm going to show you how to turn your small portfolio into a profit powerhouse that pays you every day, week, month and year. So the first thing that you want to do is pull up a list of futures contracts that have options available to trade on them. And the reason why we do this is because we are looking for two things: a high probability of success and a high return on capital. Using options, specifically writing options contracts, allows us to get a high probability of success, and writing those contracts on futures allows us to get a high return on capital, because futures uses what's called span margin, and that allows us to be very capital efficient, and that's what's going to give us a high return on capital. So if your broker doesn't display a native watch list with futures that have options available to trade, then just take note of these ticker symbols and make your own custom watch list. Once you've got that up, you then want to order everything from high to low IV rank, and I personally like to do it this way. The reason why is because volatility affects option prices. When volatility is high, option prices are high, and when we write options contracts, we are short those contracts. And anytime you are short in the market, it means you are trying to sell high and buy low. Now, when IV rank is high, that means implied volatility for that specific underlying is high. So that's when we want to sell and be short, and then play the contraction of volatility back down to the mean and hopefully further below. And the reason why this works well is because volatility is mean reverting. So with that in mind, you want to only look at things to trade that have an IV rank of at least 30. Anything over 30 is considered high. Anything over 50 is considered very high. But if something is like super high, just be mindful of why it might be super high. Do some research on that specific thing. Find out what's going on in the world. And generally speaking, I like to be anywhere, mid to high. If you want to go right to the top, that's absolutely fine, but mid to high is usually where I like to be. Now, futures contracts take into account the absolute IV level when calculating buying power requirement as part of the span margin calculations. And because of this, if you have a smaller account, you typically want to go with an underlying that has a lower implied volatility, and you'll typically find that with currencies. So for example, the Aussie dollar futures, the euro futures, Canadian dollar futures, and so on and so forth. The Japanese yen, you'll notice that the implied volatility is quite low on these things. You've also got treasury bonds, 30-year bonds, 2-year bonds, etc., 10-year bonds. The implied volatility on these things are typically lower than some of the other futures that you can trade. So if you have a larger account, by all means just trade whatever you like. But if you have a smaller account, maybe stick to futures, maybe stick to currency futures. So with that in mind, I have got my eye on the euro futures. It has an IV rank of 55. It has an absolute IV level of 7.8%. So let's take a look at the expiration dates for the euro. So on the left here, we have the option expiration dates, and then next to it, we have the futures contracts that correlate to those expiration dates, because not only do option contracts expire, but futures contracts also expire as well. And if you have a good broker, all of this information will be automatically displayed for you. You don't really need to worry too much. So as we can see, February 7th, March 7th on the option side of things line up with the 6EH5 futures contracts, and then April 4th, May 9th, and June 6th line up with the M5 contracts, and then so on and so forth. You have the U5 and whatever else. So with that in mind, you don't really need to worry too much about the futures contracts. We're going to be mainly focusing on the options expiration dates. So with that in mind, the expiration date that we want to pick needs to be between 30 and 60 days out in time. So we've got 42 days on this contract here, March 7th. So that's the one we're going to go with. And we're going to open that up, and now we are presented with the options chain. So very quickly, on the left we have calls, on the right we have puts. This horizontal orange bar shows us where the current price of the euro futures is sitting with respect to the strikes. This vertical orange bar shows us what the expected move is of the euro. over the next 42 days we have these dotted blue lines that show us our standard deviation levels, and we've got positive delta on the left and negative delta on the right. So we're going to get a high return on capital because of the product that we're trading. We're using options. We're writing options contracts on futures contracts. That allows us to be capital efficient. So now what we need to worry about is getting a high probability of success. So when we are short a contract, an options contract, we don't want price to go near that our strike. We want price to stay away from the strike that we sell the contracts at. Now, if we know what the expected move is, we can simply just write contracts outside of this expected move, and that's going to give us a high probability of success. But the further out we go, the less premium we collect and the lower our return on capital will be. So there is a sweet spot, and that typically lands us in and around the 1 standard deviation level, which sits outside of the expected move, and that will also line up with the 15 to 20 delta range. So if we start off with delta, we've got 15 delta here on the call side at the 1.08 strike. We've got a 15 delta here on the put side at the 1.025 strike. And as you can see, both of these contracts are sitting in and around the 1 standard deviation level. We are in between 15 and 20 deltas, and we're also outside of the expected move. And these are 3 points of confluence that you can look for when setting up your trade. So what's happening here? So we've created a range for ourselves, and we effectively want price to stay within this range. We do not want price to be outside of this range at the point of expiration. And what's the likelihood of price being in this range in 42 days time? Well, we have this number down here, POP, which is probability of profit, and that's our probability of making at least 1 penny on this trade, and that's at 74% right now. So already, if we wanted to hold this position to expiration, we've got a 74% chance of success on this trade, which is very high. Anything over 50% is considered a high probability trade. Now, what if we don't want to wait all the way to the expiration? What if we want to get out early, at say 50% of max profit? Well, we have P50 here. It's not displayed for futures. However, your P50 is typically going to be between 10 and 15% higher than your POP. So we are looking at probabilities of success of between 74 and 90%. Okay, so very, very high probabilities of success. This is before making adjustments. This is before any trade management. These are just your vanilla off the rip numbers, which are already very, very high. Also, this is not taking into account the fact that implied volatility is generally overstated compared to actual volatility. So in reality, these numbers would actually be even higher. So how much money can we make on this? Well, this is the price down here in the middle, 0.0042. This is what we would look to get filled at. And if we did get filled at this price, after you multiply this out by the contract multiplier, for futures, you know, these are very large products, so it's in the hundreds of thousands, but you don't need to worry about that because your broker will do it automatically. So once it's been multiplied by the contract multiplier, we arrive at our max profit here, and this is in dollar terms. So $525 is what we would collect in premium upfront on this position as soon as it gets filled. And our broker is going to require just over 1.25k in buying power to open this position. So we are already looking at a high probability of success and a high return on capital. And remember, this is not per year, this is within the next 42 days. Okay, now what if you wanted a higher return on capital? Generally speaking, I do look to get slightly higher return on capital. So what if you want a higher return? Well, we can go a little bit more aggressive and go to the 20 delta on either side. So we move our contracts to the 20 delta on the call side, 19 delta on the put side. As you can see, we're still in and around the 1 standard deviation levels. We're still just outside the expected move. And if you take a look at these numbers here, now we will collect $725 up front, and our buying power requirement is just under 1.4k. So we're looking at a return of over 50% in the next 42 days, and we have a POP of 68%. So the more aggressive you are, the higher return on capital, but the lower your POP and probabilities of success will be. In this case, we've still got a POP of 68%, and our P50 is going to be in and around 78 and 85%. So still very, very high probabilities of success. Now we also have this number here, theta, which is $21.58 as of right now. Now this is how much we are going to get paid per day on this position, assuming everything stays the same. And this number will become more and more aggressive as we get closer to expiration, which is in 42 days time. Theta exponentially increases and becomes more aggressive. So assuming all things stay equal, we'll start off collecting $21.58 per day in theta decay, and this number will increase over time. Now, with that in mind, you can be even more aggressive. However, I personally would leave it at this. If for example IV is super high, you can go to say the 30 delta mark. Let's say if you go to the 33 delta on the call side, 30 delta on the put side. Now, we'd collect 1.3k up front, and our buying power requirement is going to be just under 1.6k. So our return is very, very high there. Now, you do also need to keep in mind your buying power requirement. You need to know how much you should be allocating to your position. So in order to figure that out, we've created a free position sizing template. To get a copy of this, just click the link in the description and click on this free position sizing template. It'll take you over to the spreadsheet. Enter in the size of your portfolio. Say if you have a $50,000 account, then enter in whatever the current VIX level is. Say if it's 23.1. Everything below will then be automatically calculated for you. It will tell you the maximum amount of buying power to allocate to any single defined risk position, undefined risk position, how much of your portfolio you should be allocating to short premium strategies in general, the minimum amount of your portfolio to allocate to undefined risk trades. What we went over today is an example of an undefined risk trade. And as long as you follow this guideline, you'll be absolutely fine over the long term. If you would like to learn in more detail about what we do and how we do it, click the link in the description, and this time click on EDS Premium. Get yourself signed up. Inside you will have access to our portfolios that will allow you to see the positions that we're placing, how we manage risk, and how we make adjustments all in real time. There's also a full course, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. It is a private community, so if you get stuck at any point, you can speak to myself directly or with other like-minded individuals. There's a 100% money back guarantee. So if once you've followed some of our trades and gone through the full course, after 6 months, if you are not profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free. It's $9.99 a month to join. The price will be increasing. However, once you're in, the price is locked in for you for life. So you are definitely rewarded for getting in early. And the aim of EDS Premium is to teach you the skill. We don't want to keep you we don't want to keep you dependent on us. We do have, our positions in there, in one of our accounts. However, and you are welcome to copy those, but we're trying to teach you the skill. We don't want you to be dependent. We want you to be self-sufficient. And once you have learned the skill, it's something that you can take with you for the rest of your life. Nobody can ever take it away from you. It's a very powerful thing to know. And we aim to get you to that point within 6 to 12 months. You're always welcome to stay and be a part of the community, but within 6 to 12 months, you should be good to go. So with that being said, I will see you guys on the inside.